Good morning, everybody. You are watching a live daily market outlook from the brokers for Wednesday, 27th of February 2013. The main characteristic of the recent movements of the market is still consolidation following yesterday's turmoil after Italian elections, with euro attempting to find a base above the recent lows, but still negatively aligned. The Italian post-election in Italy stalemate, where no political group secured a clear majority in parliament, is now causing concerns among European officials and still in the markets. While the other important release yesterday, actually, what the key release was Bernanke's comments, Bernanke's testimony, today's testimony that started yesterday, and he still supports the Fed stimulus program, seeing it as a benefit for the U.S. economy, and this is actually the main outcome of his comments, the highlight of his yesterday's testimony. Bernanke said that he basically strongly defended the U.S. Central Bank monetary stimulus before the Congress, easing financial markets worries over a possible early retreat from bond purchases. This was the highlight of last week, when some hints and comments from other officials of Federal Reserves hinted that possibility of earlier stopping the bond buying action caused a lot of movements in the market. Bernanke said the Fed policy makers are still aware of potential risks from their extraordinary support for the economy, including the possibility that it might fuel unwanted inflation or stoke asset bubbles. But in testimony on the central bank's semi-annual report on monetary policy, Bernanke said the risks did not seem material at the moment, adding that the central bank has all the tools it needs to retreat from its monetary support in a timely fashion. His words are, "We do not see the potential costs of the increased risk-taking in some financial markets as outweighing the benefits of promoting the stronger economic recovery and more rapid job creation." Bernanke told the Senate Banking Committee. The Fed chairman also urged the lawmakers to avoid the sharp spending cuts set to take effect on Friday, warning that they could combine with earlier tax increases to create a significant headwind for the modest economic recovery. As said, the markets are in the consolidative mode, but still within the recent trends. As said, the euro is consolidating above yesterday's low at 130.17. The near-term structure is still aligned towards the downside. The sterling is showing basing attempt above the last Monday's low at 150.69. Again, quite negative tone, still sees potential down towards 150. Dollar yen is in the bearish pennant pattern consolidation following sharp fall, consolidating above fresh low at 90.85. Again, we see more downside pressure. Confirmation will be seen on a break below 90.85. That would open way for a confirmed basically the recovery, as the pair cracked and closed yesterday below important 92 support. Dollar Swiss is still in the sideways, still limited below 93.34 recent peak, but overall bulls are still in play and still keeping the focus on the upside targets at 93.81, 87. Crude oil remains under pressure following pullback from 98.63 recent peak, as the price hit fresh low yesterday at 92. Brief consolidation is seen underway towards touching, basically cracking 93.00, but still overall tone is negative, while conversely gold maintains positive tone after breaking close above important 1600 and regaining our next target at 1620 that has been cracked yesterday. This is also 50% Fibonacci retracement, keeping overall positive tone in play for possible further recovery. This was the brief highlight of the market movements. Of course, we are going to take a more detailed look in the technical part. Just to take a look now at today's calendar that has quite a big number of releases. Important things that came, GfK consumer climate for Germany came slightly better than the February's release, 5.9. That was as expected, and the euro was slightly higher on upon release of this indicator. Swiss Coffee Economic Barometer for February again came above the expectation that was at 1.03 was the release. However, it's still below January's 1.05. Private loans and the M3 money supply from Eurozone are due at 9 o'clock. GMT expectations are around slightly lower from the previous releases. MPC member Bean is due to speak at 9:20 GMT, and then important data from UK. The GDP for fourth quarter shows no changes according to the forecast. It's going to fall like the third quarter by minus 0.3%, showing that UK economy is still in troubles and still shows no signs of recovery. Across the ocean, durable goods orders from states due at 13:30. Core release is forecasted at 0.3, below the December's 1%, while the durable goods orders for January are expected to further contract by 4.8% compared to minus 4.3% in December 2012, and the continuation of Fed Bernanke's testimony, today's testimony. It's continuing today at 1500 GMT, and also at the same time we have pending home sales for January from United States, 1.7 improvement in January seen compared to the negative release of minus 4.3% in the month of February 2012. Crude oil inventories are due at their regular time at 15:30 GMT. 2.4 million barrels build is seen in the past week compared to the bigger one in the previous week of 4.1 million barrels built. ECB President Mario Draghi is due at 17:30 GMT. And then data from Far East, 2145 New Zealand building permits. We have no forecast. 9.4% was December's release. Japanese manufacturing PMI for January, again no forecast. 47.7 is the December's release, and the industrial production for January is expected to contract to 1.6% against the December's 2.5%, and that's all for today from the economic indicators. Again, focus is on Bernanke's testimony, and of course the US data that are due to be released, with important releases from Europe already out, from Switzerland and Germany, giving a quite positive outlook according to the releases, as immediate reaction of the local currencies show the current releases as supportive. As said, single currency, we start technicals with the euro as usual. Remains in the downtrend. We are in the daily chart of 137.10, 1st of February high, with slightly over 61.8% of the uplift from 126.60 to 137.10 seen so far. A break above the main trend line supports, and break below 50% retracement of the entire move keeps the bearish signals in play. However, the indecision now is seen on yesterday's doji candle that resulted basically in the current confirmed the current consolidation. Near-term structure, our structure is showing some signals of improvement, but is still far from any workable solution at this point, as we hold below We have 55 days hourly moving average at approximately 131 zone, 131.07 currently, and then the previous highs of yesterday at 131.20, along with 131.32, 38.2% retracement of the entire down leg, and 131.44 previous low of last Friday. Basically, we are facing 131.2040 resistance zone, seen as a immediate break point for some stronger recovery. Otherwise, it's still possible that focus is still at the downside, as shown on the 4-hour chart, where the price cracked the channel support on its break yesterday to 130.17. As long as we are holding below the channel resistance, which is approximately at 132.80, and the previous highs of Monday at 133.15, more focus is still seen towards the downside. Immediate support on the downside is at 130.00, psychological support as well as a low of 4th of January at 129.96. That is seen in the near-term focus, as indicators are still in the negative territory on lower and the larger time frames, still keeping more focus towards the downside. However, some further consolidation is not ruled out, but to signal any to signal any stronger corrective action, we need to see the break above 131.40 and then 131.67, which is 50% retracement, in order to pick up some stronger recovery. As said, on the larger picture, key barriers are seen at 132.80, and 133.15. That will be initial signal of basing at current lows 130.17, and would allow for some stronger corrective action of larger 137.10 to 130.17 down move. The British pound against the US dollar, the near-term bears are back in play following the brief corrective action of Monday's fresh low at 150.69, with the prices being capped at 152.20. That also marks 61.8% retracement of the last Friday to Monday down move, including the gap lower from 153.15 to 150.69. Near-term structure still sees potential for some further extension lower. Still keeps the basically focus on our near-term target at psychological 150 level, but development of bullish divergence of RSI and the MACD shown on the 4-hour chart does not rule out a possible further consolidative corrective action at this stage, as we are approaching a strong and psychological 150 support. I mentioned yesterday that hesitation on approach to this level is quite likely, and we might see some consolidative, at least, if not corrective action. Still a lot of work to be done in order to confirm this scenario. Break above yesterday's highs at 152.17, 152.20, and also that marks 61.8% retracement, will be seen as initial signal, while confirmation will come on a break above 153, 153.15, recent highs of last Friday. That will allow for some that will avert actually the immediate downside risk. However, larger pictures shows the pair firmly in the downtrend, with the strong signals given on the break of previous breaks of some very important supports. That keeps the overall negative tone in play. As we can see, we have lost the main bull trend line, also the multi-year range floor, as well as 50% retracement of the larger 135 to 170.41 ascend. That overall keeps the downside favored for now. But on the near term, some corrective consolidative action is still not ruled out. However, holding below initial 152.20 resistance will not produce much of the recovery. As set, break above here and the more significant 153, 153.15 would give us some more space, would open more space for corrective action. Dollar yen is consolidating, as we said in introduction, in the pennant, bearish pennant pattern following a sharp fall from last beginning weeks, gap higher opening and posting fresh high at 94.55 with the subsequent sharp move that slumped to 90.85 on Monday. Since then, the recovery regained the initial 92 barrier. This was the previous strong support, now reverted to resistance, and managed to close on Monday above this level, but a further weakness down to 91.12, and yesterday's close below 92 still keeps the downside vulnerable. As bearish pennant is continuation pattern, this suggests that further weakness and a possible attack at 91, 90.85 is more likely at this point. The current structure in the hourly chart supports this theory, as the price still holds below all three 10, 20, and 55 days moving averages, and indicators still hold in the negative territory, lacking momentum for any more significant action that requires a break above 92.70-80 zone, which is the recent recovery high posted yesterday, 92.73, and the 92.76 previous low of last Thursday. Also, it's a 50% retracement of the entire down leg from 94.55 to 90.85, and the break above here would provide the near-term relief and allow for some stronger corrective action. 4-hour structure is again negative, and no signals of any more positive action at this point. Most likely a break below this triangular downside break below this triangular consolidation will be signaling the fresh extension lower, and basically this is required to confirm that the major reversal of the pair following a loss of initial support at 92.00. This was the higher base since beginning of February. As said yesterday, this long red candle on last Monday was initial bearish signal. Then we had doji yesterday. Still not a clear situation, but as said, quite a negative tone on the near-term studies. Still favors the downside at this point, as long as we stay below 92 as initial and the 92.70 seen as a break point. Basically, break above 92.70, 93 would shift focus towards the upside. Otherwise, a loss of initial 90.85 and the 50% retracement at 90.67. We're talking about retracement of upleg from 86.81 to 94.55 would be confirmation that the pair is entering the stronger corrective action of the larger rally from levels at 77 zone from September 2012 that peaked at 94.55. As said, break above, break above 92.70, 93.00 is to shift focus higher, and would still keep our initial upside target at 94, 97, 2010 high in play. Otherwise, a more likely scenario at this point is seen towards the downside, the fresh extension of the corrective action that will focus 90.85, 90.67, and then 90.00 is around the figure support. Dollar Swiss is still lacking strength and momentum for some more significant upside action, as shown on the hourly ADX and the 4-hour. Also, there is there is sideways movement at this point. Bulls are sidelined, and the pair still moves within the recently established range at 92.80 on the downside and then 93.40 on the upside, excluding the spike lower down to 92.29 that resulted in the quick recovery. Still, hourly structure is showing that is running out of steam and lacking strength for any stronger action at this point. Basically, it lost momentum following the several attempts through the range top, several successful attempts, while 4-hour structure again is losing momentum and still sees potential for further sideways movement. But still, the studies on both 1 and 4-hour are still positively aligned and still keep the upside more focused. As long as we are holding above initial support 93.00 and then 92.80, the current range floor, with the Fibonacci levels also being included in this support. 92.78 is 38.2% of the latest rally from 91.82 to 93.37. Holding above these levels keeps the immediate bulls in play. Otherwise, break lower would signal some stronger reversal. Important, and the break points for the near term are seen at 92.30 and 92.00. That would sideline bulls. As break below 92, that marks 92.00 and then 91.80, the higher low of 20th of February, would signal possible end of this recovery rally from 90.20 to 93.37. So basically the break point is seen on the 92.00, 91.82. However, still positive structure still sees the upside favored at this point, as long as we are above 92.80 immediate range floor. Again, doji candle appeared yesterday that confirms the near-term sideways scenario, with our targets still remaining in play. Key barriers 93.81 and then 93.87. That would allow for some stronger recovery of, we can see on the weekly chart of the down leg from 2012 high at 99.70 to 90.20 low of 2013, with the 93.80 187 also marking a 38.2% of Fibonacci retracement of the entire down leg, and seen as a upside break point that will confirm the base at 90.20 and open way for some stronger recovery that would at the later stage look for a test of next strong barrier at 95.00, previous high of November 2012. Also 50% retracement of 99.70 to 90.20 descent. And from commodities, as I mentioned at the beginning, crude oil remains under pressure. As we can see on the Ichimoku studies, the price penetrated the daily cloud, and now the faster moving average Tenkan Sen broke below the slower one Kijun Sen, with penetration through the cloud, giving initial signal on the larger picture Ichimoku studies for further bearish action, as the price is already in the corrective pullback of 98.63, peak of 13th of February 2013, and has so far retraced 50% of rally from 85.20 to 98.63. Break below the channel support, and the base at 95.00 has triggered the downside acceleration, seeing now more potential for some stronger recovery action. Temporary support was found at 92.00. That marks 50% retracement, and the near-term basing attempt is seen at this point as a slight improvement of the hourly. Studies sees potential for some stronger corrective action, with the recent initial resistance and yesterday's high at 93.41 seen as initial barrier. This is also close to 23.6% retracement of 97.47 to 92.01 down leg, but more significant will be break above 94, 38.2% retracement, and the high of last Monday at 94.43. That would allow for some stronger corrective action. 4-hour indicators are still negative, but all aligned towards the upside. We need to see break above initial dynamic resistance, which is 93.10, the 20 days exponential moving average, in order to confirm recovery. At this point, I would say, okay, it's the lower time frame, but still there is formation of diamond-like pattern at this point, as we can see it on the 4-hour chart. That could be initial signal for some possible recovery and reversal of a stronger support at 92.00. This is psychological support as well as 50% retracement. Okay, we have quite a good shape of the diamond at this point, and the trend line resistance comes along with the previous high of yesterday at 93.40. That will be seen as initial recovery signal while the break above 94.44, that is high of last Monday, to confirm the near-term base at 92.00. And finally, the yellow metal, we just need to find it. Okay. Recovery from a recent low at 1554 posted on 21st of January. It seems that is gaining pace, as we had the initial barriers at 1600, 1597 previous low, and 1600 as round figure resistance, along with the 38.2% retracement of the down leg from 1684 down to 1554, clearance of which now opens way for stronger recovery. As if you remember, we mentioned in the previous session, 1600, 1620 are seen as the key points. A brief denting of 1620 as 1600 has been cleared, sees now potential for stronger recovery. This confirmation that bulls are gaining a pace at this point. We have also the previous high of 18th of February at this level. So break here would confirm the near-term base at 1554 and allow for stronger recovery. The near-term studies are supportive for such a scenario, as all indicators are in the positive territory, with the current consolidative action so far being contained by hourly 20 days exponential moving average, and seeing room for further extension higher. Immediately on the upside, we'll be looking for, let me just try to find, I will be looking for test of the next barrier, which is Fibonacci 61.8% retracement, and 1652, which is 76.4% retracement. This is also the previous low of 28th of January 2012. Overall, still positive tone seen on the lower time frames, and the reversal of the indicators that started to pointing higher from the oversold zone on the daily chart keep quite good potential for some further recovery of the recent heavy losses that gold suffered on the, especially on the latest down leg from 1684 down to 1554. That also prevents the price testing a critical 1520 support, as price also returned back to the bearish channel. More corrective action could be seen at this point, but overall negative tone is still seen in play, and as long as we are holding below 1684, 88, this is the channel resistance, and also previous highs. Not much on the upside to be expected, but since we are talking about the near-term structure, some corrective action still might be seen extending up towards 16. There is something wrong with this chart. 16 through 1620 towards 1634 and 1650. A regain of 1650 would be quite could be seen as a quite supportive element for the current recovery. But still, as said, the yellow metal remains in the firm downtrend, and this move could be just for now described as corrective and probably preceding a fresh weakness, as long as we hold below 1684, 1700, which marks the the channel resistance and the previous highs. And pardon, that will be all for from my side for today. Please, if there is any question or suggestion, you can send it now. Aussie dollar. 1 second, please. It's a quite interesting situation, as the Aussie dollar remains under heavy pressure. Following a slide from the recent high posted in January 2013 at 106 zone, breaking below all the relevant levels, and looking for test of initial support, which is 101.50. This is the low of October 2012. That will be signaling a full retracement of 101.48 to pardon 105.97 rally. On the larger picture, also this marks the larger range established in approximately in July 2012, limited on the downside at 101.50, on the upside at 106.00, with the range floor now coming under increased pressure following a strong slide. A strong slide from after testing the range tops at 106.00. Overall negative tone keeps the downside favored on the daily as well as 4-hour studies that are firmly bearish at this point, while also the similar is with the hourly. I have no any signal of any basing attempt, as basically the pair now tests the previous low at 102 posted yesterday. More likely this is psychological support. Some consolidation might be seen, but according to the technicals, it's still firmly towards the downside, and a possible extension down towards 101.50 is quite likely scenario in the near term. Any other question, please? Seems that we have no questions, no further questions, so we'll conclude today's session. Many thanks to all of you being with us, and expect, of course, to see you tomorrow at the same time at 8 o'clock GMT. Still, Ben Bernanke is still to speak today, although I would say that most of his comments have already been priced in the current market movements, so don't see something very spectacular to appear, but however, this is one of the highlights of today's calendar. I wish you a nice day, and the most important, profitable trading. We'll talk again tomorrow. Good luck.